Okay, so we're gonna get into paper 3 here. Paper 3, you're gonna follow this. You don't have to do this abstract at the beginning. That doesn't make a lot of sense in this paper. But we're gonna walk through this template for analysis. So we did liquidity last class, which is always the hardest part. It's the hardest thing to assess for any firm. So I'm gonna walk through what I did for Walmart. You should have your firm up and loaded with all your data and be ready to ask questions specifically about your firm if there's an issue there. And hopefully the Zoom is working. The Zoom's not working. I have no power over that. I'm not focused. So if the Zoom goes down, the recording, it shows the Zoom is not recording. Let me know. I got that little button right there. But all right. So we're going to do liquidity. Liquidity, we're going to look at 3 things with liquidity. The first one's really simple. Just look at cash from operations and just ask the question, is it healthy or not? The second thing is the hardest part, which is the working capital requirement. So we'll see how I assess that. I was just grading that paper for that part of the paper for another class, and boy, they struggled with. These were non-finance majors, graduate students, and they just could not handle. About half the class just could not handle it. So we'll talk about it. It's a tougher concept, and then we'll get into the free cash flow discussion, which is pretty involved. It's not difficult. It's pretty involved. But just asking the question, is this firm producing free cash flows? If it is, we should see these type of things going on. So rather than actually doing the free cash flow, I might talk about the free cash flow definition because I saw it on Monday in one of our investment society classes, and the poor teacher that I was picking on him, but you know, it's a question I've always had, so we'll bring that up. So let's walk through this. So the first thing is just show the cash from operations. So you have this chart. So I think we talked about this before. So if you look at the Walmart chart, Walmart, you brought in your company and pasted the numbers right there. Everybody remember how you did that? You just brought your company and pasted it in. You changed your company name on the second row here. And so you got print page 1, which gives you some good CAGRs, and you actually want to put print page 1 into your paper as the last part of paper 3. I would stop at row 51. But you want to show that in your paper. And then you have all these graphs. And then as I said, for the graphs, I will add a sheet that says graphs used for your company and just copy them over one at a time. As you use them, change the title, change the chart number, change the y-axis, whatever it needs to make it just look really, really good. So, so you notice my chart 1 there, but then the chart I actually use, I changed up the title, changed up that y-axis. So, you know, you want to clean it up before you put it in there. I think what most students do is they go in and just plug their graphs in without changing them, just so they can write the paper. And then they go back and fix the graphs and put the final graphs in. And one thing to be really careful of, I don't know if I've told y'all this or not, but be real careful when you copy the graph. I strongly recommend you paste it as a bitmap. I don't recommend you do it as a Microsoft Excel object or graphic object. Do it as a bitmap or use your snip or whatever. If you do it as an Excel object, it changes all the colors, all the fonts, everything gets messed up. For some reason, going from the Excel into the Word, Bill Gates says, oh, you know what? I think he wants to change everything, and he just messes the whole thing up. So do it as a bitmap or do it as a snip, either one of those. You want it to be a picture. And I know, you know, Microsoft's trying to make it so if you change one of the numbers, it updates, but you don't want the numbers to change this paper. You want it to stay the same. It also gets real frustrated if someone else opens it on another machine, you get all these link errors and all that. So paste it as a picture. But if I were you, I wouldn't worry about the prettiness of the charts. I would just put the charts in there in order. They're in the order they're supposed to be, just so you can see them and talk about them, and then go back and fix them at the very, very end. So the first thing is just cash from operations. Cash from operations for Walmart was very, very, very flat, and then COVID hit. So many of you are going to have COVID impacts, sometimes positive, sometimes negative. So you have to try to figure out, which way that's going, and if it's going to reverse the next year. I'm trying to think which of your companies, Exxon obviously was hurt really badly when you're doing Exxon. A lot of firms in the tech side weren't impacted or were helped quite a bit. Costco was probably helped, I think, probably did pretty well. NVIDIA, I think it did all right in this. I don't know, semiconductors, it's interesting because you got this massive shortage and, so there's this demand, pent up demand. So that's probably hurting them somewhat. So, I put it in the title. What you have to decide is how much do you put in the title, but if you got too much to say for the title, that's where a text box can really be helpful, and you can put extra stuff in the text box sometimes. All right, so pretty easy here. We're going to talk about a growth rate. So you have to just pick your adjectives and adverbs. So I say subdued pace until 2021, and then suddenly you had a solid growth. So it was only 0.5 until 2020, and then 2021 it jumped up about, however you want to explain it. But this is exactly what you'd expect in retail, given what's going on with Amazon or all the competition. All right, so that one's fairly straightforward. You're just explaining, if it has unusual shapes, and you try to explain the shape as well, as I did there. The next one is net working capital requirement. So net working capital requirement, you look at your company on print page 1, and you go down to line 31, that's where your net working capital requirement is. It's working capital assets, those receivables, inventory, prepaids, the liabilities, the payables, the unearned revenue. So assets minus liabilities gives you the working capital requirement. If it's a negative number, that's good. That means it's a source of cash. So you have to get in your mind that a negative number is a good number. But I'm talking about this number here in C31. The dollar is negative. Some students look in the CAGR, and if the CAGR is negative, they think, oh, it's a source, but it's not the CAGR. The CAGR just tells you how it changes. So column C, is that a negative number or is that a positive number? If it's a negative number, their working capital is a source of cash. And we saw that with Walmart. It's a really good thing. There's no current ratio, there's no quick ratio. We don't use those in finance. It's just really looking to see how are they managing those receivables, those inventories, those payables. So for Walmart, it's a source. If it's a source, what would you like for this CAGR to be? A high number or a low number? It would be as high as possible because it's a source.
Your date goes 2021. I expected it only 2020.
Right. That's just because Walmart, for some reason in Bloomberg, their January 2021, they say that's 2021. But if you go to their annual report, I think it shows that it's 2020. Every single company in here, your 2020 is where you went. Walmart was the only strange company like that. Now, it's just some bug in Bloomberg. But yeah, all of y'all, let's go through 2020. But if you want to bring more current data in, you certainly can. If you want to go reload your numbers, it's possible your firm had 2021 come in. I definitely would not change, if you want to bring your data in again, I would not change the industry to 2021. It just gets really, really messy. We're in kind of a strange limbo right here. Most firms, 2021 will be available sometime next year. Walmart, I think their fiscal year ends in January. So I would consider a fiscal year ending January 2021 to be their 2020. If you go to annual report, I think that's true, but it's just some bug in Bloomberg where Walmart's like a year ahead of everybody else.
I think it reports like January 31st of the year for Walmart. That's why it goes 2021.
Right, but there's other companies that do that and they don't show it as 2020. And I don't think their annual report shows it as 2021. Their annual report shows it as 2020, I think. So, it's a strange. Tariq was saying there's a few places where you have some strange, there's a few times where I messed up and it formatted the date. If it formats it the date, well, it did here, but I don't know why it worked there. But anyway, so if you get something where it just looks like it's 1916 or something, it's probably just I entered 2012, the year, and it's looking at that year as if it's a date. It's probably on like the competition or something, you know, somewhere in here where you get a strange date. I try to fix them all. The spreadsheet's getting a little unwieldy. You know, it's tough to have a spreadsheet that you can give to a class of 40 and it works, or class of 50, it works for everybody without any bugs. There's always going to be some bugs. All right. So for Walmart, it's a source, so high growth rate is great. If it's a use, if your C31 is a use, you want a low growth rate, even negative would be good. All right, so if it's a source, the higher the growth rate, the more liquid they're becoming. If it's a use, the lower the growth rate, the more liquid they're becoming relative to the rest of the business. If it's a negative growth, that's really good. Make sure in your paper, if you're talking about a growth rate, that you say growth rate. I have students that will say, Walmart's net working capital requirement was 6.75%. Well, that's absolutely wrong. So the growth in their net working capital requirement was 6.75%. The working capital requirement was $15 billion. It was a source in 2021. All right. So I do take off for that kind of thing. Be real careful. All right. So for Walmart as a source, if your working capital is a source, you've got a liquid company. There's just no question. Companies that generate cash through their just normal operation, their cash conversion cycles negative, those are liquid companies. That's the envy of the industry. Most of your companies, it's going to be a use, so be real careful. You've got Walmart as examples. A lot of students think, oh, my company is a use, therefore my company is a disaster liquidity. That's not true. That's a normal situation. Right? Just because it's a use doesn't mean management's messing up and it's a liquid company. What you say, if it's a use, then what you have to do is look at the trend. Is it becoming more liquid or less liquid? All right. So you say it's a use of cash. That's a normal for most companies in this industry. Therefore, we want to look at the trend in working capital over time, see if it's getting better or worse. All right. So I love this chart. It takes a net working capital percentage of CFO. I think it's a great chart, but it does cause problems in a few companies because we got two numbers there. So this chart could be driven by net working capital requirement, but there could have something happened strange with the cash from operations for your firm. I saw that today, and I can't remember which firm it was. I think it was actually C.H. Robinson. Boy, thanks to whoever told me that you can do this. This is just incredible. So I think it was C.H. Robinson. So if I bring that over to Walmart, let me see if it was C.H. Robinson. No, it wasn't them. Well, it might have been. But you could really tell when you looked at the firm. No, it wasn't them. It was somebody else. So I don't know who it was. But you could really tell that the reason that ratio jumped up is because something really unusual happened to cash from operations. It was like 12 billion, 13 billion, 2 billion, 15 billion, 16 billion. Had nothing to do with net working capital requirements. That something unusual happened with CFO. So if that happens, what do you do in that case? This data used for charts, you go find that cell, you just take it out of the chart. So you just have a spot there, all right? So if you see a chart where it just goes like this, go find that point and just delete, all right? I don't mind there being a break in the chart. I used to change the y-axis, but I think it looks really ugly when you have a line just goes off the page. This looks strange. So I'd rather you just take the dot out, all right? So you gotta be careful. There are times, maybe I can replicate this maybe with Walmart. Let's say the number just dropped down like that. You get something like that. That doesn't tell you anything, right? You can't see anything what's going on here. This looks like a lot. So if you see something like that, then just go find that. Just take it out of the chart. And you have this, right? And that's perfectly fine. Because what is our focus in this chart? What are you finding? What's the story you have in this chart? It's all about net working capital requirement. If the CFO is messing up the chart, then take that out, all right? Questions on that? So you can edit these things around. You'll have to make sure you know how to It's this page called data for graph building, and it's numbered by the charts, and you can usually see those things, real easily. Right. So what do you want this line to be? You want it as low as possible. So going down is good, going up is bad for liquidity. And that doesn't matter whether it's a negative number or a positive number. Higher means less liquid, lower means more liquid. And since I'm doing it as percentage of CFO, I'm looking at it relative to something else going on in the firm. So it somewhat is a relative look. So Walmart was getting much more liquid up until 2020, and then this happened. So what went on there, I went and looked it up, and unfortunately for Walmart, they were doing something weird this last year. There was some other category that was just doing something weird, and I didn't feel like reading I read it and it didn't tell me anything. It had something to do with some special transaction to do with a subsidiary. It caused that kind of big jump. And so, yeah, I can't explain it, unfortunately. So try your best. What I usually do is on something like this, you're trying to figure out what happened. So I can show you in the spreadsheet. You go down to the very bottom of the spreadsheet. Where'd you go? Oh, right here. Lines 54 through 59. You see it looked like working capital. They got less liquid, right? It went from negative 17 billion, 11 to negative 15. So you look at these accounts and see if something sticks out. Does anything stick out? Something happened there, right? And something happened here. So I go into the annual report and I try to find those lines in the balance sheet. I find them and they're under other. And so I'll go under other, and under other, they're in other. So it's other. And so then I have to go and research that. And they have a big discussion about it that makes no sense to me at all. So I don't really understand what's going on. So there's something bizarre going on there. It's hard to explain. You don't need to spend 40 hours trying to figure that out. Now in real life, you're going to have to figure out what's going on here and read about it and figure out what are they doing. Is it simply an accounting entry that's really not that important, or is there actually something going on with this firm? Now, what you can do is get the first quarter financials and see if those accounts went back, or if they stayed just like that. Is this a permanent thing? That's the kind of thing you're trying to see. Was there a one-time thing and then it's going to jump back? But that's a pretty hefty accounting change. And I just can't explain what's going on. So unfortunately, usually when I see something like that, it's like, I gotta know. That's how you know you're a finance person. It's like, I'm not going to sleep until I figure this out. But I was really tired, so I went to sleep because that Walmart was of no value to me. All right, but you can do that. So these lines down here at the bottom, you can try to figure this out. Is it something going on with inventory? Is something going on with payables? So you can get some good sense. You're trying to look at years like here. Here it jumped quite a bit. Can you see what jumped there? Something happening. Something's going on with accounts payable. What in the world is that? Why did Walmart's accounts payable suddenly jump from 2016 to 2017? Did their cost of goods sold jump? I don't have cost of goods sold in there, but their cost of goods sold, what's going on? That's pretty strange. That's a hefty, look how consistent it was before that. 38, 37, 38, 38, 41, 46. Something bizarre going on there. I'd really like to know what that is. But you have to go in and see what that is. Usually when you have a change this big, the accountants have to explain it, but it doesn't mean you have to explain it in English. So they use a lot of jargon, and it's not always like, oh yeah, I see what they're doing. So it's just really frustrating. But you should at least try it. This is your job as a finance security analyst. If you see something like this, it's your job to dig into the numbers and figure out what they're saying. If it doesn't make sense, then you call the sell side, right? That's what the buy side does, calls the sell side. The sell side doesn't know, they call the CFO and figure that, you have these avenues to do this in real life. In this class, you don't have that approach. But accounts payable is up $11 billion in just the last few years. Inventories are the same. So don't we usually think of accounts payable is how you buy your inventories, but how can inventories be flat, but accounts payable be up $10 billion, right? So aren't you all curious? Like, don't you want me to stop class and go figure that out? And that's what a finance person is all about. So I've tried, it's just hard to figure that out. Definitely have a huge impact on the firm. So that's why this line is down so low. Payables and receivables have just been flat and accounts payable shooting up. What did I say? More research is needed or something like that. So, all right, so do your best in this part. This is the part. Now, I'm going to tell you one more time, if you send me your paper, highlight what you want to look at, all right? So if your CFO is growing at 12%, and you said CFO is growing strongly, you don't need me to read that. So if you're having struggles, then, highlight the parts you're having struggles with. This might be a section where you're kind of struggling. All right, no questions on that? That's usually the hardest part of paper 3 for most students, or not all students, not all students. All right, the next one is this free cash flow concept. I'm gonna throw this out to you because some of y'all may be taking this class now. This is another area where we should have a sweet debate with one of the other professors, Professor Sweet versus Dr. Catapagan. Be like, Mike Tyson versus Sister Teresa or something like that. And he would take me out in the first 20 seconds, but it'd be pretty fun to see. So what is free cash flow? They take net income, they add back depreciation. Actually, they take EBITDA, right? Or they take EBIT, they tax adjust it, they add depreciation, subtract working capital. They might subtract CapEx, and that gives you free cash flow, right? What is that right there? Anybody know what that number is? EBIT, take out tax adjustment. Why? Because depreciation is tax deductible. Add back depreciation. What does that look like? Isn't that cash from operations with interest expense added back? Isn't that all that is? There's other things in cash from operations, sure, but maybe you should be looking at them from a free cash flow standpoint to see if they're there. So here's my argument. If free cash flow is so critically important, and whom do the accountants work for? Y'all remember that? The accountants work for us, and we're using the statements, and free cash flow is the most important number. So what should cash from operations be? Shouldn't that be free cash flow? Shouldn't the accountants give us free cash flow since that's the number we need? So I've never understood why we're so fixated on EBITDA. And it was, well, what's the problem with EBITDA? EBITDA ignores what? Working capital. Well, working capital is really, really important. You use EBITDA, you're saying, well, working capital is not important. We don't care about those inventories growing so fast. So that's what I don't like about EBITDA is it just says we don't care about inventory management and all these other kind of things. So if we take EBITDA and subtract working capital, we should be getting the CFO, but CFO has these other things in it. There should be on the cash flow statement a line that says free cash flow and then other things below it. We should just be able to go and pull that number. Why can't we subtract CapEx? Some CapEx is a free cash flow, some of it's not. Costco builds a new store, that's CapEx. Is that a free cash flow or not? That is a free cash flow, right? They didn't have to build that store. They could have sent that cash back to their stockholders. So that is, you wouldn't want to subtract that out of free cash flow. So the accountants could do this, couldn't they? Are any of y'all taking accounting right now this semester? So ask that question. You're probably taking like auditing or something. But, if you're taking financial statement accounting, why don't the accountants give us free cash flow? So I've never quite understood that. So I'm just going to ignore the whole thing. Instead of calculating free cash flow, I'm instead going to ask, where's the evidence that it exists? If a firm has free cash flow, what will they do? They'll pay dividends, they'll buy back their stock, they'll pay down debt, all right? They'll do CapEx, increasing CapEx, they'll acquire other firms. The one thing I left out of here was the cash balance. Are they building up cash? So if you're doing Apple, you might actually add that in there. Apple or Microsoft or Alphabet, these firms that are building up their cash balances to these huge amounts, so you could actually look at that and see. If they won't have it in cash, they have it in cash and in investments, so you have to do a little extra work. But I have everything except for that building cash balance. So I'm looking here at this, at Walmart. There's their dividends, very, very constant over time. They buy their stock back, kind of lumpy. They borrowed some money to buy Flipkart. Looks like Walmart is a very strong free cash flow firm. You don't write a $16 billion check if you're not producing free cash flow. All right. Their CapEx has been falling. That seems strange to me because I see all these new Walmarts everywhere, but their CapEx is falling. Why is their CapEx falling? So are they paying money to their stockholders because they're producing free cash flow, or is it because they're cutting back on CapEx? And it looks like it's probably a combination of the two. And then acquisitions, there's Flipkart. So if your firm is doing acquisitions, you're gonna have to handle that. I was talking to Will about that earlier. If you have a firm that does a lot of acquisitions, that's a whole section to your paper too, because that's really pretty critical. Firms that acquire a lot of other firms, that's, you know, I'd like to actually meet the department that makes those decisions, because boy, they're central to the whole success of this firm. Acquisitions is a really expensive way to grow. I think in my class notes, we're going to talk about growth later. Dan Madarian talks about the best ways to grow. To me, the best way to grow is just get more customers. The second best way is to build more stores. The third best way is maybe acquire other firms. But he talks about, you know, finding new uses for existing products. That's a great thing to do. Finding new markets for existing products. That's pretty cool, but that's expensive because you got to build more stores and new distribution. But buying another firm is a very expensive way to grow. So why did they buy Flipkart? What was Walmart after with Flipkart? Well, India, right? They wanted 1 billion people in India. Isn't India going to be larger than China here pretty soon? And that's a big market with a decent middle class, growing middle class. So that makes some sense that they want to be in that market. They bought JetBlue back here somewhere. And I didn't think that was that huge of a. It looks like the JetBlue is actually starting, and Jet.com, excuse me, is actually starting to benefit them quite significantly. When they did that purchase, there's a lot of people really criticizing them. They overspent, but it seems like it's working. I've not bought anything on Walmart.com in my entire life, but someone must be, because it sounds like it's working. I don't think Flipkart has been working very well, but who knows? You know, give it some time. So that's what you're looking for in this section, is just, is there evidence they're producing free cash flow? And if they are, what are they doing with it? Okay, so if you answer those 2 questions, and I've given you 3 charts, you can create another chart if their cash balances are growing, but those are the questions you want to look at. Questions on that? That can be a little tricky because there's just so many moving parts. Yeah. Nothing. I wouldn't even show the chart. I'd take it out. You know, if this chart and this chart are exactly the same except for one, you know, I probably could have left this one out and just talked about the Flipkart purchase and say, you know, first of all, it shows they didn't use free cash flow to buy Flipkart. They had to go out and actually borrow money, but they have paid back quite a bit of that debt. So they are doing some acquisitions. If your firm does a lot of acquisitions, that's where it gets interesting. If you have a recent one, like in the last few years, you really need to go figure out what that acquisition was and discuss it, because that's pretty material. All right, and we've got the M&A expert here. So if you need some help, go talk to Jabari. I don't know if have you used the M&A function on Bloomberg yet? No. You should try it. Bloomberg has. So if you're having trouble with acquisitions, Bloomberg has an excellent mergers and acquisitions. So you just plug in M&A, and if you're not sure how to find it, just type search and then type mergers and acquisitions. I think it's just MA is the function.
Yeah, it is. I'll do that.
Yeah, don't MA is also MasterCard, but if you just do MA without hitting FA, it'll bring up that function and you put your company in, it gives you, I don't know how far back it goes, but it goes back pretty far. You can get quite a bit of detail on your firm. It's going to tell you if it's cash or equity and all kinds of stuff. So it's really pretty cool. All right. So there's liquidity. Questions on liquidity. Any of y'all have something strange with your firm you want me to use as a class example? One of your companies doing something.
On my chart 4B, I mean, it shows that, I mean, in 2012, they did do an acquisition, but it showed that it's negative 80% to the CFO.
Yeah, if you have that, then there's two things going on. Again, I'm dividing by CFO. So your CFO could have been negative, or they could have sold a firm. All right, so if you sell a firm, then it's negative because they got cash in. So look and see which of those is making it negative. Let me pick on Costco here.
I was gonna say, if this is the chart, we probably wouldn't use them.
Yeah, if you only have one acquisition, don't even show the chart. Just say they did the acquisition, yeah. But that's not the one I was talking about with Costco. Let me show you Costco, because I really think, I'm hoping the people doing Costco are going to answer this for me. Where is Costco? I can't, my alphabet. I don't know, is someone doing Crocs? Boy, you know, I'm just amazed Crocs is still in business. I have one pair of Crocs that I use every time I go outside to get the mail or something. I got robbed once, and the guy, I was fighting, he was beating up this lady in the HEB parking lot. So I confront him, he steals my wallet, I get it back, then he grabs my phone and starts running. I'm wearing Crocs. This kid is like 20 years old, I'm 50 years old. I finally take the Crocs and just throw them. I'm running barefoot. I catch him in the street. He loses his shirt, through his shirt. We're running through traffic, people are honking at us. But anyway, that's my Crocs story. Y'all don't want to know the end of that story. It's not all that interesting. But anyway, all right. So look at Costco. Look at their. You would think Costco would have this Walmart-like dividend over time, right? Just what in the world is Costco doing? The dividend policy is just so bizarre. 1.5, 1 billion, 600, 4 billion, 700, 3 billion, 3.6 billion. It's not every other year either. There's 3 years, 2 years, 2 years. So
They do these big periods where they give back like $10
all at once.
all at once.
So is there a strategy where they say, once this happens, we're going to do it? Or is it
Yeah,
simply they just,
They get enough money built up. they get-
but is there actually a kind of a trigger point?
I don't think.
Or is it just they get together and say, we might do it?
I think
So
it's a board decision.
this is not what most firms want, right? If you're going to do dividends, you want it predictable every year, just like a Walmart. Or you don't do dividends, you do stock buybacks. And why would you do this and do stock buybacks, which just seems really bizarre. So it's a very unusual strategy, but I think Costco, and you can kind of see this, I think one of the reasons they do this is Costco's always been different. And this might be kind of a game, is another way for them to be different and do something bizarre, but yeah, they're a very unusual firm. So you got to somewhat, that's such a strange looking chart. You got to,
Take out those special dividends.
I don't think you want to, because that's really critical to what they do. It's going to make it really difficult for you when you forecast them, because you have to figure out some way to figure out what their dividend strategy is. But yeah, I think it's important. You don't really want to change this chart because this tells you a lot. Any other of your companies, you've just seen something bizarre in one of these charts? Any of y'all have a chart where it's just going off the page? And those can be the trickiest. Before you just delete the number, go figure out why. Is it because something happened with the numerator or something happened to the denominator? And if something happened to the denominator, especially if it's cash from operations, if your cash operations just nosedive in 1 year, I would go try and see if you can figure out why that happened. And that one's pretty easy to do. All you have to do is go get their cash flow statement and just see if you'll see something humongous just shows up in that year. Be a dividend payment. It could be they sold the subsidiary, had a realized loss, and they actually add the sale goes through investing activity, but the realized loss goes from cash from operations. So it can be something like that. So you can explain it. that is something, a bond that you can adjust for. If they had like a $5 billion adjustment for a subsidiary, you can actually add that back to your cash from operations that year and just know that's an adjustment. So yeah, if you're trying to normalize your cash from operations, you can find those kind of things. And those will be in their annual report. They'll talk about it. All right, so I'm not hearing any questions. Once you get paper 2 done, get the liquidity section done. Students ask, how long does this take? Well, Sergio and who else was in that class? Sophia's not here. Harvey. They had to do it as an exam, so they had to do it in 75 minutes. So it can be done in 75 minutes. Your first draft could take you 75 minutes. That shouldn't be your last draft, but you can get a fairly decent draft. You could probably get a passing paper in 75 minutes. Go the right direction. All right, solvency tends to be the easiest, all of them. So let's do solvency. So there's 2 things we're looking at with solvency. First, do they have too much debt? And secondly, the debt that they have, can they handle it? All right. So what are ratios that we use? Debt to equity is the one you're usually taught, or debt to net worth. I'm noticing that ratio is disappearing in most of finance. If you go to UTSA or Victory Capital, they use debt to EBITDA. It's just become, and that makes more sense to me. If you're borrowing money to buy a house, I seriously doubt the bank asks you what this mortgage is versus your net worth, because most Americans' net worth is 0 or almost nothing. What do they ask? Your mortgage versus what? Your earnings. That makes a lot more sense, and that's why debt to EBITDA just makes more logical sense to us. How much debt do you have versus your earnings? So debt to EBITDA or debt to EBIT have now become far more standard. Assets to equity, we're going to use that later when we do ROE decomposition. So that works there. That's what we call, if you took the FAC exam, they call it the equity multiplier. So it works in the ROE decomposition. So those are ratios to see, do you have too much debt? Is this firm overladen with debt? And we'll focus on debt to EBIT or EBITDA. I think I use EBITDA, but I switch between those 2 all the time. The second one is, can you afford to make, can you handle the debt that you have? And that's times interest earned. I am not a big time interest earned fan, but Dr. Damodaran, he loves times interest earned. So, so there are people out there who like it. To me, it's a strange ratio. You're taking earnings before interest and taxes and divided by interest expense. Would you do that with your mortgage? This is how much I make, and this is not my mortgage payment, but this is the interest portion of my mortgage payment. That just seems like a really bizarre thing to do. So anyway, but EBIT. So Dr. Damodaran, when he's doing his analysis of Miller Modigliani, the optimal level of debt, he uses times interest earned as his proxy for credit ratings. I've never tried that, just times interest earned, and see how highly that correlates with credit ratings. But it's possible. I should do that analysis to see. So higher is better there, higher is worse here. I don't know why I have this wonderful font changing around, but anyway. So what is too high? Well, in debt to EBITDA, it all depends on what your industry is. So that's why I gave you the 80%, the 90%, 10%, and the median. But all you can do is you can really assess 2 things. Are you in line with the industry? And is it getting higher or is it getting lower? If it's getting higher, then that's bad. They're getting more levered. Getting lower, that's good. They're getting less levered, less risky. Times interest earned, we do tend to have standards there. 2 is dangerous. Above 10 is great. Between 2 and 10, then you look at the trends. So I essentially say, hey, if you're around 2, you're in a lot of trouble. If you're between 2 and 10, then is it going up or going down? If you're above 10, just say not an issue and be done with it. So you don't have to say, hey, my firm was 212 last year and this year they're 175. I'm really worried. No, you're not. It's 175. Because what's going to drive this ratio? 2 things are in this ratio: interest expense and EBIT. If the ratio's bouncing around, what's most likely causing it to bounce around? It's probably the earnings. right? So it's not that they became more levered, it's that their earnings fell some. And that's no big deal, you know, they went from 212 to 17. Now, if your ratio is 15, you're good unless you do this. I have students to say my times interest earned was 15%. What's wrong with that? Times interest earned is not a percent, is it? It's the times. Your earnings are 15 times your interest expense. So your earnings are 15, your interest is 1. If it's 15%, you're in a lot of trouble. That means your earnings are 15 cents and your interest expense is $1. You're losing a lot of money. So don't put a percent on that. All right, so it is times. You just say times, 15 times, 2 times, 10 times. Use the word times. X is fine, but just don't do percent. Okay, be careful on that. All right, so if you're well above 10, I don't think it's an issue. You don't have to talk about the trend. You know, it's just very, very strong. There are other ones out there. Altman Z. I'm not a big fan of Altman Z score. I really think Altman Z really comes into play if your times interest earned is close to 2. So to me, Altman Z tells you if someone's about to go bankrupt. Once Altman Z gets above a certain level, it just tells you they're not about to go bankrupt. But a 7 is not necessarily better than the 5, and 9 is not better. You know, once you get, I actually did a correlation of Altman Z, the credit scores, and there was no correlation. I could have done it just to maybe below investment grade, maybe there wasn't any correlation there. But Bloomberg does have a ratio. We're going to use the Bloomberg in paper 7. Paper 7, you need some measure of risk. So you can bring in debt, you can bring in times interest earned, you bring in all these other things. But usually the best thing is just bring in the probability of default because it has all those other things. So like in one number, you've got everything you need. And it does have a good correlation to credit ratings. So for our purposes, we're going to look at times interest earned. Or you have to look at debt EBITDA. And wouldn't it be nice if you had some outside source to confirm everything you believe? And I put this under solvency. This really goes under both solvency and liquidity. All right, so don't think of credit ratings as the end of solvency. You've got liquidity, you got solvency, and then you're going to summarize liquidity and solvency using credit ratings. All right, view that as the overall summary. And what are credit rating agencies doing? They're looking at net working capital requirements, they're looking at CFO growth, they're looking at what you're doing with your cash flow, they're looking at your debt to equity, debt to EBITDA. And then the last thing, again, this is a summary for both solvency and liquidity, and it's a quality of earnings discussion. And I'll show you what I do there. All right, so solvency tends to be pretty straightforward. One thing I like about Altman and Bloomberg, Altman, his formula is out there. You can get it on Wikipedia. So he'll give you something, and it's going to be a lot of the same kind of stuff we're looking at here. And the Bloomberg, probably to default, Bloomberg does provide that ratio for you as well. So you can actually dig down into these ratios. So you're trying to figure out why your firm does really badly on the ratio, you can actually dig down into the ratio. And it's good because some of your firms don't have credit ratings. If you don't have a credit rating, the Bloomberg probability is actually a pretty decent ratio. If you're not really sure on the Bloomberg, if you go to the Bloomberg machine and type CRPT credit report, yeah, I think it's CRPT, and click on the Bloomberg, they'll actually associate the Bloomberg probability of default with the credit rating. Whether it's below investment grade, average, or high, you can actually kind of substitute that in. And there is a fairly decent correlation between those two. I like to use the 5-year Bloomberg, but they do have other. I think they have a 1-year. You have others. All right. So solvency should be fairly straightforward. So if we go to the Walmart times interest earned, they're well above 15 consistently. And this last year, it really jumped up quite dramatically because of COVID actually helped them, and it seemed to help the entire industry. What I say there is just not a serious concern. Even if I were looking right here, it dropped from 20 to 15. This just doesn't worry me all that much. 15 is such a strong number.
We have the 90th percentile a lot higher than the median of, the company we distribute to.
Yeah, I would take the 90th out. I left the 10% in here. I don't know why, but I left the 10% in here. I do take, if it's a lot of zeros, I do tend to take the 10% out. It's all zeros because it doesn't really tell me anything. This one's kind of interesting because what happened in 2020, but yeah. So make sure if you got a report, I don't know if I have one that's really wild, but I've seen some from some of the companies where it's just like the financial leverage, I would probably take the 90% out. So you got to decide. Sometimes, you know, here it's really helpful. I think this one's a fairly useful one. Especially given, well, I've got Costco in there right now, right? So this is Costco. We talked about that before. I didn't switch numbers back to Walmart. I should do that. Can I do that? There we go. Well, I love Control Z. Don't you wish you could do Control Z in everything in life? Wouldn't that be wonderful? All right, so, you know, you decide which of these lines. You always have your company, you always have the median. When would you leave the graph out entirely? If your firm doesn't have any debt, there's no reason to show charts 5 and 6. All right. I don't know why there's an A on this chart. Take the A out of the title of that one. It shouldn't be there. I just left it there. So do what's the chart numbering. Don't go chart 3, 4, 7, 8. You know, don't have chart 9B if there's no 9A. You know, look at the chart titling. Do it in a smart way. The second thing, debt to EBITDA. So it jumped up with the Flipkart purchase, but they paid off that debt the next couple of years, so it came back down. So I'll just say they're below the industry here. I left out the other lines. They're below the industry. The industry jumped up, probably because EBITDA fell because of COVID, more than likely. And that's it. That's it for solvency. It's really, well, one last thing. Talk some about the growth in debt. Look at the trend. So, you know, it's the reason you have to talk about it. This is debt to EBITDA. So there are two things in there. There's debt and there's EBITDA. So EBITDA can be messing that up. So look just at debt itself and see how it's growing over time. Okay, get some sense of that pattern. So I'll look at these two, chart 6 and the discussion of growth and debt. I'll look at those as one thing together to talk about. And so then you're done with solvency, and now you're going to bring solvency and liquidity together. And what I'm looking for there is first quality of earnings. And you can actually word for word me here if you want to. I don't really care. You can copy. Well, you don't have to copy and paste. You start with the Walmart as your first draft anyway. So here's my theory. Quality of earnings is a really hard thing to measure. So we're going to just do a quick and dirty kind of look here. But my argument is if a firm is really in financial difficulty, that's when they're most likely to start playing with the books, trying to do some fancy accounting to try to hide things. And when you do that, you're usually going to see some big disconnect between earnings and cash from operations. So let's look at this chart and see what I'm doing here. So the top of this chart is cash from operations. The blue is net income. So what am I doing? I'm taking net income and I'm making these 3 adjustments or 4 adjustments to net income to get me to CFO. So below the line is something I'm subtracting from net income to get the CFO. Above the line is what I'm adding. So the red is the most obvious. I'm adding back depreciation. Change in working capital is a really important one. That one's probably going to kind of flip back and forth a little bit. The other differences, and we've already talked about that, right? With Walmart, we saw that massive change in 2021. The other differences, that to me is interesting sometimes. If it's in the last couple of years, if it happened like 7 years ago, I might not care. But if it happened the last couple of years, I might be, what is that? I mean, it's really interesting. What is that big bump there? The nice thing is it added to my liquidity, so that's kind of nice. But what exactly is that? My net working capital kind of bounces around, but nothing all that alarming. So I'd probably put in the paper that, you know, I don't see any funny business going on there, except for I would surely like to know what that other adjustment was. And again, it has to do with that interplay between the accounts payable and the other assets. I put deferred taxes in there. It hasn't been a big of a number for Walmart at all, but it could be a big number for your firm. Especially with the 2017 tax change, but even with Walmart, it wasn't that big of a change. Has anyone seen some massive stuff here? And most students say, I don't see anything unusual. I've had students that had something really unusual and they said, I didn't see anything unusual because they just want to get off. But do look at it. You can focus your attention in the last 2 or 3 years though. So don't feel like you got to go research something that happened in 2012 and figure out what they did there. But, you know, I mean, unless it's just some massive, massive number. So the biggest things that you see in other is a pension contribution are usually it's a realized gain or loss. So remember how that, I'll say it again, I did it earlier, but just if a firm, let's say they sell a sub, let's say the book value was 2 billion and the sales price was 1.5 billion. So they had a loss, 500 million. So where does the sales price go in the cash flow statement? You remember that? Where do they put that one? That is a cash flow, right? Where does that cash flow go? Cash for operations, cash for financing, cash for investing, where does that go? Cash for investing, okay? Well, where does the 500 million go? It comes right out of net income. All right, so your cash flow statement has 1.5 billion, and yet you have this 500 million in net income. What do you have to do with that $500 million? Your net income was reduced by $500 million. What do you do in the cash from operations? You have to add that 500 back in because it was a non-cash. Okay, and so yeah, that's how they handle this. And so it's lumpy, but it tends to be a one-time thing. And that's why I was saying, if you really wanted to and you had something like that, you could just add it back to your CFO and be done with it. Taxes is a little bit of a problem and it does mess things up, but that could be it. That isn't what happened here. Then you have a final conclusion. Walmart's, I'm saying, man, they're extremely liquid. Something happened this last year I couldn't figure out, but they're extremely liquid. Their debt was a problem with Flipkart purchase, but it looks like they've gotten that back under control. I don't have serious concerns with this firm, and they're AA rated. That is an incredibly high rating. And I have to see if I think I have the credit ratings in the class notes, don't I? Let's see. Nope, I don't. I'll have to give y'all. I'll give y'all the credit ratings out there. So what I do on the credit ratings is I just quote S&P, not Moody's. Moody's is too wordy, but I just quote S&P, and it's actually pretty. I think it's AAA is extremely strong capacity. AA is very strong. Single A is strong. Triple B is like adequate. And then below that, they add the word vulnerable that I can't spell either. So, but I'll get you those, and you can just, whatever your firm is rated, you put that there. If your firm doesn't have a rating, just mention, this firm is not rated. However, Bloomberg does provide a proxy for that, and just talk about that. I did put the Bloomberg in there, and here I left a 0.10 in there just because I wanted to show Walmart was even lower probability of default even than the 0.1 percentile. This really should be the 10 percentile, but I typed that wrong every single time. All right, so that takes a short term. So I'm not worried about this firm going under. Now I can go and look and focus on growth. All right, so I feel pretty good. I think most of your firms, that's probably the case. If you're doing Bed Bath and Beyond, you might be worried about short-term viability. If you're doing JCPenney, you're certain they're not going to survive. Sears, they're already dead. They're just waiting for the end, So, but most of y'all aren't picking firms like that. Someone jokingly asked me about doing GameStop. Yeah, I can't imagine what this paper would look like. They haven't made money, and who knows what it looks like. It'd be a really hard stock to do. All right, questions on liquidity and solvency. So, get paper 2 behind you so you can really get this out of the way while it's somewhat fresh in your mind. All right, now we go to what is my favorite topic, which is turnover. I'm a little bit obsessed with turnover. So turnover has three parts. The first and third part are really easy. The second part's the most missed. In fact, I've just graded a bunch of papers. I think 90% of the class got it wrong. And I don't know why. They must just be a horrible professor they have. I don't know what the issue is, but most of the class got it wrong. So the first one is turnover is top line growth, revenue growth. It's the business growing. We're not asking if it's profitable, but just is it growing? Are they getting more revenue? All right. So the first one's pretty simple. Is revenue growing? Walmart's revenue is growing 2.53%. Let's go to the class notes, though. I should start with the class notes. But the three things that are focused on revenue. So what we're focused on is revenue growing, and then second thing is how much effort are they putting in the revenue growing? Is revenue just growing magically just because it's a great company and everybody loves their product? Or are they having to build new stores, put in new distribution systems, hire more workers? You know, I'd love to have revenue growth with no effort. That would be wonderful. You know, if Walmart could suddenly have 20% more people walk into their store, wouldn't that be a wonderful thing? Not to build another store and they just have all these people walking all of a sudden. That'd be wonderful, but that rarely happens. So that's what we're asking is, are they getting revenue growth and how much effort are they putting in to get that? So activity ratios, turnover ratios, or just focus on that top line. Whenever you see turnover, you've got some measure of revenue in the numerator, and whatever the ratio is measuring is in the denominator. So asset turnover is revenue to assets. Inventory turnover is not it's not revenue to inventory, but cost of goods sold to inventory. Accounts receivable turnover. So you put some measure of sales in the numerator and some measure, whatever the ratio is, in the denominator. Now, I've given you 4 ratios, revenue to square foot, revenue to employee, revenue to store, and revenue to property, plant, and equipment. You also have receivable and inventory turnover, but in the Bloomberg data feed. I didn't actually build a chart. If you're doing retail, inventory turnover would probably be a good one to bring into your paper. Now, if you look at these ratios, you'll suddenly notice a high correlation between liquidity and turnover. If you're improving your liquidity, probably what else are you doing? You're probably improving your turnover. Right? Because if your inventory turnover is getting better, then your net working capital requirements are getting better. Right? If you're turning your inventory over faster, then you're gonna notice that in a much better net working capital requirement. So there's firms who's improving their turnover are probably getting more liquid. At the same time, firms that are getting more liquid are often getting better turnover. So there's a high correlation in those two things.
What would you expect the backwards effect?
Moving backwards.
Net working capital, by lower.
Well, because there's so many more things in there. Asset turnover includes things that we don't look at in liquidity, because that includes property, plant, and equipment. All right. So net working capital is just looking at inventory, accounts payable, and those kind of things. So it's possible they're not doing well because, you know, Carver Cruise Line, you just built a new ship and you haven't put anybody on the boat yet. You haven't gone out that's going to make your asset turnover look horrible, but your net working capital may be fine, unless you bought a lot of inventory for the ship or something. So yeah. All right. So how efficiently is management managing these assets? You know, I was reading the story of Merrill Lynch. They bought a fleet of helicopters because their CEO wanted to fly the helicopter around to scope out golf courses before he played on them. What does that do to their sales, and what does that do to their asset turnover? Looks like an incredible waste of money, right? The corporate yacht, maybe that helps your turnover because you put, you know, big customers on the yacht and try to sell more to them. But, you know, so there's some firms that are very wasteful in these areas. So then we get these collection periods where you take 365 and divide it by that ratio. Lower is better here. here on turnover, higher is always better. You want high as possible, always better. But the periods you want lower is better. How quickly do they turn these over? So you take 365 divided by that ratio. Boy, I don't know what's going on with my fonts. That's just really bizarre. Bill Gates, for some reason, thought I wanted to switch fonts around. So inventory turnover is, we don't use revenue, we use cost of goods sold. So we don't have that markup impact in there, but cost of goods sold to inventory, again, higher is better. With just-in-time inventory management, you hope that ratio is getting much, much, much better, or you hope your day sales inventory is getting shorter. Shorter is better. You want to turn that inventory as fast as you possibly can. Well, I mean, within reason, given, you know, if you're Walmart, yeah, boy, you're just trying to churn that thing. If you're Tiffany's, maybe, you know, that's kind of hard to incentivize your sales force to turn. But that doesn't mean Tiffany's doesn't care about inventory turnover. They care about it. It's just not the focus of their business. They're not trying to get people to turn over quickly, but they don't want it to deteriorate. They don't want some $60,000 diamond sitting in their store for 5 years. They do want it to sell and turn over. These are very industry specific, so that's why you got to look at these ratios versus other companies. I didn't do that for you for inventory turnover. You'd have to create that yourself, but you could easily do that in Bloomberg. Just bring in all of your, you've already got all of your companies, or I have all your companies. If you want to create that and look at your industry's inventory turnover, see how they're doing, that you can certainly do that. But what if you're in the service sector? Inventory turnover doesn't make much sense if you're in the service sector. So you have to find other things. So revenue per employee is a really good one. If you're doing a Accenture or NVIDIA, those type of firms, revenue per employee is a really, really good one to do. So how good are they managing these processes? So let's look at some of the ones you'd be interested in. If I'm doing Nike, I want to look at revenue to advertising sale. Now, you don't have advertising dollars in your Bloomberg, but Capital IQ does have their marketing budget for Nike and Adidas, and you can look at it. So revenue per the advertising dollar, that's a really, really good one. If someone's doing Carnival Cruise Line, I would be looking at revenue per cabin. Same thing with hotels, same thing with hospitals, revenue per cabin. That's a really, really good one to do. Telecom, I don't think anyone's doing telecom, but customer accounts, or if you're doing like a Facebook, it's, you know, how many users you have, those kind of things. Facebook is actually really, really interesting, looking at their ad revenue per Facebook user. Yesterday, you know, it was 0, right, for like 6 hours. That's what you're looking for is, you know, that's how Facebook draws advertisers to their platform, is how many users are on their platform. Available seat miles for airlines. I don't think anyone's doing it. Airlines. Okay, so Javier, you might be able to do this for your company. So if you need help on it, let me know and I'll help you find. But for utilities, they do revenue per regulatory assets. A regulatory asset for utility is an asset the regulators let them charge a rate for it. And so you definitely want to bring that in. Very, very important number for them. If you're doing energy of any kind, energy companies, pipelines, you can do revenue per proven reserves. There's a lot of numbers you can bring in for Exxons and those type of companies. If you're doing a firm that does a lot of CapEx, you can do revenue per CapEx. Or if you do research, you know, think that, or research and development. If you can get that number, revenue. Now, if you're doing pharmaceuticals, research and development, there tends to be a time lag, right? You spend $5 billion this year and the revenue shows up 4 years later. So you may have to do some kind of timeline or something. So sometimes what I'll do with these ratios is I might do a 3-year average and then do revenue. So revenue for the average of the last 3 years, something like that, just so I kind of get that in there. But property, plant, and equipment, if I'm doing an Intel or a firm that has a lot of property, so NVIDIA property, plant, and equipment doesn't make much sense because they don't build anything. But if you do a lot of property, plant, and equipment, it'll work. If you're doing a retail store, revenue per store or revenue per square foot is fine. Target and Costco, I mean, Target and Walmart, I like to do revenue per square feet because they have stores of very different sizes. Costco, I like to do revenue per store because they're all about the same. What if your firm does a lot of online and they have stores? If you can break those up, you can try to do that to get those two different pieces, but see what you have. This is a place where you might see if Capital IQ has something different than Bloomberg, or you might go to Bloomberg Machine and see what they have that I didn't bring. So on Bloomberg, what you do is the FA function, the financial analysis function, and then you click on segments. And when you click on segments, you can get a lot more detail on your company. So here's the place. The reason I think this is so critical is I think this is actually the most important thing management does. It's kind of tied with CapEx, but where do they do their CapEx, and then how do they focus on sales? I think this is more important than margin, mainly because I think most managers can handle margin, managing expenses and that kind of thing. That's not so difficult. Getting more customers to show up at your company, that's a really hard thing to do. That's why I love that Cinnabon business breakdown podcast. She does such a great job. I don't know if y'all ever Kat Cole, anybody looked up her history, really incredible person. Very strange history, but my word, she certainly figured out finance. But there you have a business where they have retail outlets that are franchises, so they don't even own those, selling this stuff in airports and malls. How does that work out in April of 2020? And your distribution system is airports and malls. That sounds pretty horrible, doesn't it? But what else do they have? They have licensing, and how do you do the licensing? So she understood that top line. So if you listen to that podcast, probably 70% of what she talks about is turnover. About 25% of it's margin, and about 5% of it is like return on capital. So you'll notice that a lot. Chipotle, listen to that one. Probably 70% of that business breakdown is turnover. So turnover is a huge one. So I really think it's where you can add your most value. You probably have a lot of turnover discussion in your paper too, because it's just so critical. If you don't get this right, your firm's out of business. Right? Isn't this what Sears got wrong? Sears wasn't managing their expenses well. They weren't managing their customers, getting their customers into the doors. So what's most closely tied to your firm's generation of revenue? And that's what you want to look at. Some firms it's really tough. If you're in Alphabet, if you're in Microsoft, it can be really tough. If you're doing Disney, I don't think anyone in here is doing Disney. Is anyone doing Disney in here? Disney's a kind of a conglomerate because they have, you want to look at revenue per cabin for their cruise lines. You want to look at revenue per hotel room for their hotels. What do you do for ESPN? What do you do for the movies? It gets really tough. Revenue per employee doesn't really work because they got these theme parks. They have thousands of employees, and Disney looks horrible in revenue per employee. But what are you left with? Revenue, property, plant, equipment. That doesn't make much sense for the movie theaters and the movie and for the ESPN. And it's just. And now you got this new Disney online digital. So Disney is really hard to do. So what you'd actually do is have a different ratio for every segment, which is practically impossible unless you have inside information. At UTSA, it was all about revenue per employee. And then 1 year I was in a life insurance company, it reclassified revenues, gap changed, our revenues dropped like 80%. And the CEO is like, what happened to the life insurance company? Their revenue per employee just dropped 80%. And tell him, well, accounting, he always would say, you guys are just making excuses. I need your number back up where it was. I'm like, yeah, that's not humanly possible. It's not going to happen. All right, so here's the key for this paper, and we'll start here again next time as well. But I want to get this part. You've got capacity, and you have turnover. You've got to talk about those two things. So what are those? So let's look at Walmart. I want to really understand this. So we're doing square feet. So Walmart's revenues grew about 2.5%. Where did they get that? Well, they got it from two places. They added about 1% in square feet. And their revenue per square feet grew about 1%. Which of these is capacity and which of these is turnover? What is square feet? Square feet is capacity. This is turnover. Which of these would you rather be the driving force? And wouldn't you love to see this minus 5% and plus 20%? You close down all the worst stores and the good stores are just killing it. That'd be wonderful, wouldn't it? Or 0 and 30, 25, that would be wonderful. So that's what you're looking for. Now, some students get confused and say, well, we want this number to be higher than that number. It has nothing to do with that. It's not one being higher than the other. So I wouldn't mind if this was 20% and this was 5%. That would be fine. 5% is a great number. You know, if inflation is about 2%, so your prices are going up about 2%, that means you got 3% more traffic. That's great, especially in retail. That'd be unheard of, right? So that's what you're looking for. This wouldn't be so good, 1% and 1.2%. Oh, essentially what I have with Walmart, right? And the problem with this is if I stopped at 2020, it would have been horrible because at 2020, they had almost no growth. They had such a great year in 2021. Almost all of this 1.33%, almost all was 2021. So Walmart, you would think Walmart's revenue per square foot would go up just with inflation, shouldn't it? You raise your prices with inflation, you should just at least get inflation there. They're not even getting inflation. So that's pretty bad. So this is what you're looking for here. So look at these two numbers. You look at it, revenue per employee. They didn't add many employees and they got more revenue per employee. You can tell we've got some bad numbers here. They're rounding it to the nearest 100,000. That's probably messing up that number somewhat. I doubt Walmart has exactly 2.3 million employees, especially every single year. It's like, we can't hire you today. We can hire 100,000 or 0. I don't doubt that's going on. Property, plant, and equipment, I don't think that really applies so much to Walmart, mainly because the most important property and plant equipment I'm interested in is the stores, and the square feet is going to cover that for me. But a lot of y'all are going to do property, plant, and equipment. And the number of stores, I don't like that with Walmart because of the super Walmarts and the kind of the community Walmarts. All right. So you've got to pick one of these, but you also have on the Bloomberg Pace Values, if you go to the bottom of that, you've got the inventory turn, the accounts receivable turn. You do have those ratios that you can work with. All right. So we're going to spend more time on turnover this next class. If any of y'all want help on that, catch me in the FSC and I'll find some really specific ones for your industry. And we can probably even bring in your industry comparison numbers as well. All right, we'll stop there. All right, so let's get started. So we're talking about asset turnover. Asset turnover is, I think, one of the most important things. As I said, if you listen to those business breakdown, well over half of what they're talking about is turnover. That's just the most important thing. And also when you forecast, where are you starting with your forecast? Going to be on revenues. So revenue is really critical for these firms. My investment class has to write their second paper on an earnings announcement. And I think it's interesting, the firms that they beat on earnings but miss on revenues. Sometimes the market is much harsher on the revenue than on the earnings. They get real upset if you miss on the revenues because they figure on margins, you can fix that, you can do things, but if your customers aren't showing up, that's a hard thing to turn around. So it's pretty critical. So I think this is an important section. There's only 3 things we look at in this section. And just to show you, so Javier was asking me, we're talking about the utility sector. So utility sector revenue per regulatory asset is the key ratio they use. So if you look at this ratio, first of all, how would you edit this ratio? Do we need the 90th percentile? You might be able to take that out. Now, what one student did in one of my other classes, which can work, you can try it, is to do the chart twice, once where you leave the extremes there, and one where you take them out and show just with the median. You can definitely do those two approaches. That can be there. Do we need the 10 percentile? Maybe not. So you look at that, and then, you know, obviously you got to fix the axis. So, you know, don't turn in graphs like this, you know, 3, 3, 4, 4. So always fix that. You don't necessarily have to go out 2 different places, but definitely want to be able to tell what the numbers are. Now, the other thing is, what are you trying to say with the graph? What is your story? If your story is they're declining or they're flat or whatever, you know, you can say they're flat. I think we talked about this before. Say they're flat just by say, look how flat that is. But you might go over the other extreme and just make it look too volatile more than it is. So you have to, you know, use your judgment to where you put the, but pretty flat for this firm, right? It's not all that particularly wild. It's about as volatile as the industry. The industry is pretty volatile. These are, I use medians, I don't use averages, so outliers don't affect the number. But does that tell you a story? And what is a story? Is your story that it's volatile, but so is the industry? Is your story that it's been flat? Is your story that you've had strong recovery since 2018? Whatever your story is, you got to make sure the graph shows it. All right. What if, and take the D out, right? Don't have a 9B if you don't have a 9A, B, C. Okay, so you take that out and you say you don't, your title is not revenue regular assets. It is revenue efficiency, flat, but strong recovery from 2018. Whatever you wanted your story to be, something like that. You know, so the firm was, so I don't, this might, I'm not trying to tell Javier what he's going to write, but the story might be, this is a firm that was on the decline until 2018, but now they've had 2 years in a row with great recovery, almost back to their highest. Maybe that's the story, but then what's the next part of the story? Great recovery because, and that's the hard part. Why? Why did they recover? Did they recover by shutting down some inefficient regulatory assets? They recover by getting a base increase. I mean, that's the hard thing with utilities. It's very regulatory, regulated. So this is what you want. You want the title to tell why, what story you're trying to tell. And then the second part is what you actually measure. Now, some of y'all had charts where great looking charts, but I didn't know what the chart was. There's no one here that said what the chart was. So make sure you say what the chart is. But this is somewhat my preference on a chart. All right. Most of your firms, and I've seen this over and over again from most industries, it's asset turnover is a very, very tough thing to improve. It really is really pretty tough. What do you think, what would you expect this line to grow by? Well, here, sometimes we say inflation, so it depends on what is your denominator. If your denominator is $1, then inflation might not be an issue because both the numerator and the denominator grow with inflation. So here I'm doing revenue, property, plant, and equipment. Those are both dollars. So we don't necessarily expect this to grow with inflation. But what would be a ratio you would expect to grow with inflation? Revenue to what? Revenue to employee, maybe? Employees don't inflate. Except, well, in dollar terms. What about square foot? Square feet don't inflate, right? So if you're doing revenue per square foot or revenue per employee, you would expect those to grow with inflation. Here's one you don't expect to grow with inflation because both the numerator and the denominator. So be careful when you're looking at the Walmart, and I say they're not even keeping up with inflation. If you're doing revenue to asset, I mean revenue to property, plant, and equipment, or revenue to regular assets, you can't make that inflation comment. All right, everybody understand that? So be careful. Know what you have. So here. The fact that they're flat might not be all that bad. You somewhat expect this to be flat. So here's a case where growth would be actually pretty impressive. But for Walmart, revenue per square foot, we hope they just at least keeps up with inflation. All right. All right, so the first thing we do is the easiest is revenue growth. Are the revenues growing? So Walmart's growth has been 2.53% since 2012, but we got this tremendous growth because of COVID, so that even that 2.53% is somewhat inflated because of the big jump this last year. So all you have to do here is give the growth and pick an adjective. All right, I don't want to see the word anemic, so you got to come up with your own word. All right, that's my word. Find another word. It's easy to find another word, isn't it? Feeble, lackluster. I love lackluster. Colorless probably doesn't work. Pallid doesn't quite work. Weak. One word I do hate, but you can use it, is robust. Y'all know what robust means? Healthy, vigorous. I hate that word because for like 4 years there, it was the most used word. Everybody visited my office. Like our robust, blah, 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 whatever. And the other one was space. I hated the word space. We're in the small cap value space. We're in the electrical utility space. And so when I retired from USAA, one of my coworkers gave me a business card that had all those words on it. Ron Sweet, he's in the equity space. He's got a robust, whatever. But you can use robust. I don't count off for it, but you got a thesaurus, so that, let Bill Gates help you out here. Hardy would be a strange, stout would be a strange word, but find what you have. But make sure it makes sense. What I don't like is uneven, because I don't really know what that means, uneven, without a picture. So if you want to say volatile, but uneven is a little unusual. I've seen the word acceptable. I'm not real sure what that means. Acceptable to whom? So, think about what word you're using. Just don't use the word anemic. The other thing is look at the pattern. So you got print page 1. Here's your revenues, the very top line here. What? I don't know what. Oh, so 0.88%. I don't know why the numbers don't match. Maybe I pulled up the wrong. Did I pull up the wrong Walmart? No, it's 2021. I don't.
You have to change the Excel to one of the examples for.
It's possible. So this is what, Costco or something? Oh, it is. Oh, this is Excel. Sorry. This is have years. I do have Walmart open. All right, here we go. What? Y'all think this is easy when you're talking to people and looking in your brain. So here it is, 2.53%. There is something you could try here. I think is kind of interesting. So you might try this with your company and see. Bill Gates, why does he do that? So you've got these numbers here, and you're trying to figure out, what is this pattern? So my growth rate, I'm just gonna go pull it. I've already got it calculated. It's 2.53%. So what does that mean? So if I grew each one of these by 2.53%, what's the last number going to be? Any guesses? You'll do that in your minds. If I copy this all the way down, what's the last number going to be? You might do that in your head. I'm going to guess somewhere around 559, 151. That's going to be my guess, right? Pretty close. Why is it that? Because that's the definition of a CAGR, right? So what can you do with this? Well, what if you graph these two things? I'm trying to see the pattern here. So they had good growth the first few years, and then it's just flat. And then suddenly the 2020 happened. Now, it doesn't always tell you something, but there's sometimes where this graph actually is quite eye-opening. Now you can't do the trend chart with, Bill Gates will build it for you, but I like this approach because it gives you, if you do the trend line, it's probably going to hit right about here or something like that. So I'm just trying to figure out, how did they get there? Was it a straight line? Did they do really well and then come back down? Did they do really badly and then recovered? So that can be helpful. So at least look through the numbers. Some of y'all have a merger and acquisition that's going to really distort this. So you definitely have to talk about that. What if you had a major merger and acquisition here? So you say, wow, in 2018, they bought this firm that caused their revenues to grow 23%. However, the growth rate since then has only been X. So you can do a growth rate since that merger, and that can give you some insights, all right? So look at the numbers, because if they had a major merger back here and their earnings growth is 8%, well, it's 8% because they bought another firm. They didn't just have the revenues grow 8%, they had to spend billions of dollars to get that revenue growth. It's a very expensive way to get revenue growth. So to ignore that is not a good thing to do, all right? I don't think many of your firms have major acquisitions. I can't remember any of y'all, but that's going to be a serious issue. Even Walmart, they bought Flipkart, but it's not a big part of their business. It doesn't, especially on the revenue side. All right. So you might be able to add a few more words here, but try to think about it. One thing I do notice in some students, they're doing Apple, or they're doing Excel, or they're doing some semiconductor, and I keep seeing the Amazon effect and retail. This is a tough time being in the retail industry. Well, you're not in the retail industry, all right? So make sure you take all that Walmart stuff out. So some students get kind of so glued to the numbers, they're not looking carefully at the words around it. All right? So be careful. You can copy and paste. This is the only paper you get to do that on, but you still got to change the numbers. Now, if you're doing Costco or TJ Maxx, you have some of an advantage that some of those words may work, but I would recommend you not use one of my sentences verbatim, okay? Put it into your own words, change it around. All right, the second one, oh, don't do that. Oh, why did it do that? Okay, sorry. Well, if you're on Zoom, you can still see it. Yeah, my life insurance class, they still do the fire drill at 10 o'clock because no one has told them in the last 7 years that we have a class that goes at 10:15. So we have this wonderful, but it's both in English and Spanish. So I do get to practice my Spanish. Why the system is shutting down. All right. All right, well, let me talk the second thing, because the second part under turnover is one of the most missed parts of this paper. So there's two things you have to talk about here. There's turnover and there's capacity. You want to make sure your turnover and capacity, you're using the same denominator, the same underlying number. So if you're doing revenue per square feet, you want to talk about the growth in revenue per square foot, which is turnover, and the growth in square feet, right? You have to have two things, but they have to be related. So which of those is capacity? Square feet. If you add more square feet, you're building a business. That is an expensive, time-consuming, difficult way to add revenue. Okay? So Walmart's revenue per square feet grow 1.33%. Does that sound like a good number? If this was Excel, that'd be a great number, right? Because you're doing revenue per regulatory assets. But why is it not a good number for Walmart? Because that should be growing with inflation, and it's not keeping up with inflation, all right? Why? Because square feet is not dollars, it's a thing. Hopefully y'all understand that. So this last one, so like, Javier, if you decide to use that one, this last comment doesn't make any sense for you. You wouldn't talk about that it's not keeping up with inflation, because that wouldn't make any sense for you. All right. So Walmart's growth in revenue per square foot and growth in square feet, we can see they're not growing their business all that much, but the business they have is just not that strong. They're not even keeping with inflation. So I'll have some students get confused and they'll do revenue per square foot and revenue per property, plant, and equipment. And they say, well, I got the two numbers, so I talk about, no, you can't do that. you're gonna do revenue per square foot, you have to have revenue per foot and the growth in square feet. If you want to also talk about revenue per property, plant, and equipment, you need to talk about growth in revenue per property, plant, and equipment, and the growth in what? Property, plant, and equipment, right? That one, you can't talk about inflation. The square feet one, you can talk about inflation, all right? So make sure you're all, anybody unclear on that? Because this is missed a lot on the paper. And you'll notice it's not exact, and I think it's, you know, somewhat the way they interact with each other, but the revenue growth is 2.5%. You add these two numbers together, you get 2.2%. So they essentially kind of compound each other a little bit. So that's the reason, but they should be close. You shouldn't have revenue growth of 2.5% and these two add up to 6% or -4%. They should be real similar. Why? Because we're taking revenue per square foot and we're taking square feet. So those two should cancel out and should end up with revenue growth. You do those other than the interaction of the two. You know, I could test the theory now. I just have to do it now just because y'all are all sitting here. Y'all think it'll work? And it should, right? No, it didn't work. Sorry. Oh, well, there's something going on here they're not adding up exactly, but it's still going to be close enough that you can talk through it. Revenue per employee only grew 2%. Can I say that's bad, or because it does keep up with inflation, or not? Someone say so. I know someone's alive tonight. Well, employee growth is 0.5%. So they've kept their employees down, but what about this? Do we need this number to keep up with inflation, or is 0 okay? That one you do. And why is that? Because this is not a dollar, it's people. Okay, now you do notice that's very unreliable number right there. That's somewhat frustrating. There's no way that's their number. So if you have something like that, I've seen some companies where it's definitely the number. I mean, it goes out, you know, 462,012, 123 or something. You can tell. But this is one of those ARD numbers, as reported numbers, where as reported data, which management has their pick of how they report the numbers. I might, if I could, go out and just ask the question and see if it's out there. Yeah, there you go again. And I can do history. Yeah, so that's a lot of help. Do they have any more data than that somewhere out there? I don't know. I couldn't find. I didn't check Capital IQ to see. Why doesn't Walmart want those numbers? I don't know. Why don't get better numbers? Obviously, you hope they know better than that. But yeah, we have about 2.3 million. But hopefully their payroll department knows. All right. Wow, look at the word I just used. I probably did that as a joke. All right, so neither is very strong, so that's fine. But if you're doing something to a dollar, any growth is actually pretty powerful. The fact that they're getting more revenue out of that property, plant, equipment is actually quite powerful. All right, so you've got to decide which ratio you're going to use. That's your primary ratio. You can't use more than one. I gave you 4 to choose from: square feet, employees, property, plant, equipment, and stores. Okay, so find one of those that works well for you. Now, if you're missing a number, I have seen this before, where there's just one number missing, like right there. It's just a number missing. What I don't mind you do is just take the average of the years around it and give yourself an estimate. All right, that's perfectly fine. So it may not be exactly right, but if it's, you know, mainly just so your graph works. I have students turn in papers. You know, I think students get so stressed out that they just don't go back and look. If I can find one here. Revenue per square foot. Well, they actually have the chart like that, and they'll turn it into their paper. Find it. There's revenue per square foot. No, that's not what I wanted. It actually, because I don't have data, it shows zeros there. And so those turning graph, does that look like that's possible? Is it possible their revenue per square foot went zero for 2 years? So look at your graphs, all right? This is important stuff. I know you're thinking, well, he's just, we're thinking about grades. I'm not thinking about grades. When you get in your first job, you don't want to give this to your boss. Okay. I can tell you from experience, you get so into the weeds when you do this kind of stuff, and you go talk to your boss, and what does your boss do? They find the most obvious thing that you didn't see, that a 6-year-old would see it, but you're so into the weeds. Boy, I've done that so many times in my career. And you hate it, right? And your boss loves it because your boss is like, see, I'm smarter than you, and I just proved it. They love it. And I had a boss once, he loved to do that, and I'm like trying to get this major thing approved, and he's fixated on that. And it's unimportant, it's just a typo, but he's fixated on that, and I can never get anything approved because of that. He's so proud of himself for finding out. I'm like, okay, can you get off of that and look at this? So for your own protection, step back and think about, what is that chart saying? Is it even possible? Don't have those obvious errors. It's not like I'm gonna count off 50 points or something if you do that, but I will count off some because you should step back and look at what you're putting into your paper. All right, so you do have those 4 to pick from. Now, you're going to put this chart at the last page of your paper 3. If you've got a bunch of NAs on this row or this row, hide those rows, okay, before you put it in your paper. There's no reason to put a bunch of NAs into your paper. All right, so hide the rows you're not using. So like with Javier, I think I built it so that you have the regulatory assets on this page. So you might keep that and the revenue per property, plant, and equipment. You might keep those 4 rows. So revenue per regulatory assets and revenue per property, plant, and equipment, but hide all the other ones. I think I put yours up here at the very top.
On the Excel one, it only shows the number of employees and the revenue per employee.
For your paper?
No, for the data.
For that, oh.
There's no data for any of the.
Well, but the file I emailed you, look at that one.
Oh, okay.
So I think I put revenue for regulatory assets here, so you could use that and the revenue for property, plant, and equipment. It's possible there's only one thing on here that works, and that's revenue for property, plant, and equipment. So some of you, that may be all you have. But again, if a lot of times you'll have one employment number missing. If that's your issue, then email me your file and I'll fix it, because now that I'm thinking about it, you're not going to be able to fix it. It's, you have I know where everything is and you don't. I don't want you spending hours trying to figure out, because it's quite a web. So if you got one number missing right there and you can see it on the chart, send me your Excel. I'll fix it in like 30 seconds. I know exactly. I've gotten this thing memorized by now, so I'll fix it. So don't let those numbers throw you off. All right. So that's very, very important. Then you have a graph that you somewhat talk about it. I left the top chart up here just because I know that's Costco and kind of interested. This is a chart I might do like this and also do it just Walmart with the competitors, mainly because this last 3 right here are actually pretty good. Walmart's actually showing pretty good revenue per square foot the last 3 years. I don't know if it's because maybe they're doing more online sales, which obviously doesn't have any square feet to it. And you have an industry that's been very flat and even declining, and Walmart has shown some good strength, but you can't see it in this chart because the 90th percent is so distorting it. All right, no questions on that one. So that's a very, very important one. The third thing is real simple. It's just asset turnover. So asset turnover, revenue divided by assets. That's a ratio that works in every industry except banking and insurance. Asset turnover makes no sense in banking and insurance, but it works well for all other industries. So what can we see there? Again, very, very flat and amazingly consistent, actually. The other thing you can notice is that the best in the industry is actually suffering. I've seen students comment on that, say, well, Walmart's is flat to slightly declining. However, given the huge decline in the industry, that actually looks pretty strong. So you can make those type of relative discussions here. All right. Most students get 100% on the first one, and on the third one, the last one, turnover, but a lot of students miss points here. So again, you might email me your paper and highlight just that one paragraph. You want to make sure you're wording it correctly. I'm more interested that you actually understand it, because I think it's a really, really important concept. If you start looking at things like this, like where does their revenue growth come from? That's the first thing to sit down and think about. What is the one asset that drives revenue more than anything else? For a lot of firms, it's number of stores they have. Some firms, it's their property, plant, and equipment. They're building new warehouses, new factories. Some firms, it's their employees. Stop and think about that. I think it's really tough for firms like Disney or Alphabet to really think through it. And if you do revenue per employee as your fallback, even that doesn't work very well for a lot of firms. So, some of y'all might struggle there, but I gave you 4 to pick from, so try to pick at least one of those or email me. We don't have too many unusual industries. I helped Javier out because his industry has a pretty special one. The rest of your industries, I can't think of any really unique ratio, but you might look through their annual report and see if there's a ratio like that they report that might be a turnover ratio. All right, let's go to margin. So margins usually is the easiest one. So you have 3 things to talk about margins. Students do really well in the first 2 with no problems, and then they struggle on the third one. So let's go to the class notes on margin first. Are y'all worried about my the title of some of my articles? My life insurance class understands that one, but all right. I'm just trying to look it up. Yeah, if you want to bring in some of these working capital things like days sales and inventory, days receivables, the sales and days inventory, days collection period, you can certainly bring those in. You have the data in the Excel spreadsheet to do that. You just have to calculate them yourselves. All right. Well, it's just real quickly. How do you improve turnover? Because if you can improve turnover, the firm will become more profitable. So if revenue per employee is your ratio, that's pretty simple. You eliminate redundant workforces. You have people sitting there that aren't producing revenue, and you can. Now, how do you artificially improve this ratio where it's not any better? Do what Boeing did, and you outsource everything. You hire other firms to do stuff. What happens to your revenue? Your employee count drops. Your revenue is the same. Looks like you did something wonderful, but instead of paying your employees, you're now paying a contractor probably 10% more, but at least you got that off your books. So you got to be careful on that. If you're Nike, you increase your marketing budget. If you got stores, you shut down inefficient stores, or you increase your online sales. So that's why in this part of the discussion, you might show your firm's sales in-store versus online over time. If you saw the online getting larger and larger and larger, that could help you explain why the revenue per store is coming up. That might be a good chart to do if you can find it. McDonald's turned themselves around. How did they do it? Their turnover rate numbers got tremendously higher because they franchised a large portion of their stores. What happens when you do that? Your revenue drops dramatically, doesn't it? But what else drops? Your assets drop dramatically because you don't own all these stores. The impact of that is what? Your asset turnover shoots up and your profitability shoots up. So you as an analyst, you're looking at that and say, wow, McDonald's is really doing great here, but you also know there's an end to that. You can't franchise 120% of your stores. So you look at them franchising their stores and eventually that has to stop. And so you know, okay, this line's going to keep going up for a while. And they're not going to franchise 100%. They're always going to own some stores so they can somewhat experiment and do those kind of things. So that actually would be a pretty powerful thing to do in a forecast to say, okay, they're going to keep converting these stores to franchise. When does that stop? When do they get? And I think they even told investors what percentage of their stores they were going to franchise. It's a pretty high percentage. But that's a tremendous model. What else? What happens to your employee count when you do that? You walk into a McDonald's, are those McDonald's employees or are those the employees of the franchisee? So what does McDonald's want it to be? They don't want those employees. What does the state of California want them to be? They want them to be McDonald's employees, right? If you got a state law that says any firm with more than 50 employees have to do this, what does McDonald's want those employees to be? They want to be employees of the franchisee, right? I mean, there's articles out there that talk about some of these firms battle with, especially states like California. And yeah, I mean, it's a big deal. But those are things you have to look at. How is McDonald's reporting those? So when you're looking at sales for McDonald's, is it just the franchise revenue or are they showing you the revenue for the whole stores? I don't think anyone doing a franchise business. I can't remember. But if you're doing a franchise, I mean, if you're looking at McDonald's that franchises and maybe a Jack in the Box that doesn't, those two companies can look really radically different. And you'd have to know that in your analysis. So, you know, these are things that are pretty important to understand. What numbers are you actually looking at? If I were doing McDonald's, I would want to know the revenue of McDonald's, the franchise. I want the entire business, not just the royalties, but the entire business. Can you get that somewhere? I'm sure they probably show it in the report. That would be pretty critical. Does revenue per store even make sense for McDonald's if you have royalties? You kind of think through that as well. And then what's the cost of goods sold for McDonald's? It's not revenue minus hamburger buns and that kind of thing, right? It's a very different kind of thing. So make sure those are really critical things. New services, always pick on McDonald's, but McDonald's offered breakfast for the first time. They didn't know if that was going to be successful. I mean, we think now, well, that's so obvious. You offer breakfast. What happens to your revenue per store if you offer breakfast? That's a huge increase, like a 50% increase if it works. If it doesn't work, what do? Disaster, right? What I think, I worked at McDonald's for 1 month, so I have a lot of experience. When I was in college, I was working for them for like $3 an hour, and then I got a job teaching trumpet for $15 an hour. So guess what I did? Quit McDonald's. Much nicer teaching trumpet, but 15 an hour doesn't sound like much, but today that's like $50 an hour is a pretty good job. But worked at McDonald's for a month, and boy, when they switched from breakfast to lunch, the whole process was this guy got this big scraper out and he scraped the grill, and that was it. Like 3 seconds. So they didn't have to buy new equipment. I mean, that was a pretty major breakthrough for them. And what happened was the breakfast actually became almost more popular than the lunch and dinner. And then what did they start doing? Breakfast 24 hours. I mean, it just grosses me out, but that was it. Breakfast 24 hours. I think they had to cut back on that because when you do that, all your franchisees are kind of stuck with that. But that's huge. Can McDonald's repeat that? What else could they do? You know, so you think through that. Yeah, that was great in the past. Can they do it again? Expanded hours, hiring more sales representatives. So I think Beatrice, you're doing Cisco, right? And so Cisco sales employees, if you can get that number, Cisco is an incredible organization. They have really good salespeople. When they increase their salespeople, their sales go up. There's no doubt about it. But I don't know, Beatrice, you can actually get their salespeople, but revenue for salespeople would be great, but they may not give you that information. But I don't know what percentage of Cisco's employment is salespeople. It's probably a pretty good chunk of them because they're, you know, that's a big part of their business. And obviously any kind of sales or sales gimmicks is going to be helpful, but there you got to be careful. You cut your prices 5%, and so your volume goes up 3%. That's not going to help you much. You can't have a 5% sale to get 3% more customers. You've got to have a 5% sale gives you 10% more customers. So you have to be careful on that. Have y'all seen some of these Facebook posts on Walmart? You know, sell, it goes like down 1 penny or something, or actually goes up. Some of these signs people didn't look at, like some of my students don't look at their graphs. So think about that as well. There are other things. No one's doing a grocery store, but company-owned brands, the kind of the personal brands, those are a big issue for some stores. So if you're not sure, call me. I can make stuff up. gotten pretty good at making stuff up. Just because reading prior student papers, I've had students deal with this, and I might be able to give you some ideas on how you could handle this with your firm. So it's not just a matter of are they getting better, are they getting worse, but how can they get better? What could they do? If I were running a grocery store chain, I would have revenue per store, number one, last place, and I'd be looking at shutting down those last place or getting new management in or doing something. If you did that, you cut your bottom 10 stores every year, your revenue per store would be going up every year. All right. So you see the word margin, you automatically know the denominator. What's always the denominator for the word margin? And say it loud because I think revenues, yeah. So margin is always something divided by revenue. What margin is it? Well, we'll start with gross margin. Again, I have an issue with gross margin because I'm not real comfortable with how the accountants classify cost of goods sold, what they put in there and what they don't. So if you have an accounting class, maybe when Dr. Sanders and I debate the quick ratio, maybe she can also talk about cost of goods sold because I don't know what the accounting standards are. I just know where I worked. There's some leeway in what you put in that number and not didn't put in that number. And it's kind of like, what do you want people to see? But right now we're just going to accept it. Whatever they give us is the number, and hopefully they're consistent over time. So gross margin and then the net margin. What is the net margin? So it can be an EBITDA margin, an EBIT margin, an EBITDA margin, a net income margin, or I don't like this phrase operating margin because it's a little bit nebulous. Usually operating margins look a lot like EBITDA margins. For most firms, they're almost the same number, if not the exact same number. So I don't like operating margin. I think I got a little sloppy on the graphs. Yeah, I got sloppy. I shouldn't have done this. So I don't like this at all. So I did something that really upsets me. I don't remember if I did EBIT or EBITDA, and you can't tell from the chart because I didn't tell you. So I highly recommend anytime you do margin, you make it really clear. So you either say net income margin, EBIT margin, EBITDA. I think I did EBIT, but yeah, I can't remember. I'll have to look it up and I'll let y'all know. I think it's an EBIT margin. I recommend you always be very, very clear on that, whether it's EBIT, EBITDA, or whatever, because it's, you know, it's important to the person looking at it. Why don't we do net income margin? Well, because there's a lot of stuff in there that really don't have to do with profitability, interest expense and taxes in particular. Depreciation, amortization, you can do it with or without, you know, EBIT or EBITDA. Depreciation tends to be so constant over time that I don't think it really changes the charts that much. It's EBIT. Yeah, I should have put that in the, y'all all need to do that. This is how I know if anyone's paying attention to me. So when I get to this chart, I'll know whether you have net margin or EBIT margin. EBIT is a net margin. Net just means, you know, you're subtracting a bunch of things. So the gross margins before SG&A, the net margins after SG&A, but it could be after some other things as well. So, so net margin. Sorry. So either one of these, I'm using EBIT. So the gross margin has to do with pricing policy, your markup. Here's where that brand identity comes in. Firms with strong brand identity will have good gross margins. Firms with weak brand identity are going to have very thin, razor thin margin. Net margin has two things going on here, and this gets a little tricky. Really three things, but net margin, whatever your gross margin did, that's going to flow through to your net margin. But then your net margin, it also includes your expense management, you know, how thrifty you are, you control. But the biggest thing on the net margin is operating leverage. Have y'all used the term operating leverage before in other classes? Do they use it the way I use it here? It relates to fixed costs. So you have financial leverage, which relates to your debt and how much interest expense as a fixed cost go through your net income. Operating leverage is how much fixed costs the firm has. More fixed costs is going to make the firm more volatile. It's also going to make good years look great and bad years look terrible. So it leverages the firm just like debt does. It's a leveraging. Firms with higher operating leverage will have what kind of betas? Higher betas or lower betas? Higher betas. Yeah, operating leverage, just like debt, makes your beta higher. So the net margin is going to reflect overall expense management. It's going to bring in the pricing power from the gross margin, but then it's going to bring in this operating leverage. How much fixed cost the firm has. So operating leverage is just another form of leverage. You learned this in your accounting class. When I took this accounting class 30, 40 years ago, I thought, wow, this is the coolest thing. If I was starting a business, this is exactly how I do it. Y'all remember the contribution margin and all of that? That's ring a bell. The break even. Remember all of that stuff? I thought it was really, really great. And then I got my first job in finance and discovered firms don't know any of this. Firms are far too complicated to know all this. You go to USA and ask, what are your variable costs? It's like, what do you mean variable cost? No, it's pretty tough to know what's the cost. So what's the definition of variable cost? When revenues go up 10%, what does it do? It goes up 10%. When revenues fall 10%, it falls 10%. What costs does USA have that move perfectly line in step with their revenues? Their premium taxes do. That's kind of an obvious one, right? You pay a 2% premium taxes. Whenever your premiums go up, your taxes go up. If they pay commissions, that would, right? Commissions are a variable cost, but USA doesn't pay commissions. I don't think USA really has variable costs. I can't think of any variable costs they have. Most of their costs are fixed costs. Now, if I were starting a business, I would be using that contribution margin analysis. If I took on a McDonald's franchise, I would definitely be using that analysis. But for most large corporations, what's the variable cost for Google? What's the variable cost for Disney? It's pretty tough, isn't it, to really figure that out? Have y'all had ABC? Did y'all cover that at all in accounting, activity-based costing? Did y'all do that at all? No, at all? How many of y'all have had ABC? None of y'all? So activity-based costing. So this is the big deal for the accountants. For the accountants, we're going to save the world with this. Just the problem was on the way to saving the world, they discovered companies are so complicated, it doesn't quite work. So activity-based costing is you try to figure out when the firm does this, it costs this. When the firm does this, it costs this. And you're trying to figure out, ultimately, what they're trying to do is you're trying to get ROE by customer. Right? That's the ultimate. All right. This customer, 50-year-old, married, 3 kids, buys these products. This is this person's ROE. Here's another one, 20-year-old college student, not married, no kids. This is their ROE. This has an ROE of 27%. This has an ROE of 3%. But this college student's going to become this person. So we can't insult them or her. But we need this person to become this married 50-year-old with kids. You know, that's what they want. The problem is when you're trying to get all your costs and all your activities perfectly aligned, it doesn't quite work. So I'll tell you how it worked at USAA. I got this form and they asked me, what percentage of your time did you spend on the USAA Cornerstone Fund? And I'm like, I didn't spend any time on that. We do asset strategies discussions, like where do you want to be overweight, underweight, and we apply to all of our funds equally. So I said, well, maybe 3%. It has to add up to what? 100%. All right, I go to 26 meetings a week. Where do I put that? Staff meeting. There's nothing on that list that says staff meetings. Where do I put staff meetings? That was like 20% of my time. Do I put that in the Cornerstone Fund? And then they go to P&C portfolio. Where do you do that? Well, that was my most fun portfolio. I want to put 100% there, but I couldn't. Do you think that's valuable at the end? So it's tough, right? I'm not saying accountants aren't competent, smart people, but what they're dealing with is extremely difficult. And that's what firms are trying to do. They're trying to figure out where all their costs go so that they can actually do like an income statement, balance sheet, and return on equity at a customer level. That would be tremendously wonderful to do. The only place I've seen that actually work really well is in the life insurance companies. Life insurance actuaries, I was pretty amazed. I was working with one actuary, and he didn't just tell me how profitable their term life was. He said, this is how profitable the term life we sold in 2017 is. Here's how profitable term life we sold in 2018. Pretty amazing stuff. But even then, there were some allocations going on that were somewhat distorting the numbers, but it's very, very tough to do. So how do you figure all this out? Well, my philosophy is if a firm has a lot of fixed costs, how should that come out in the net margin? How would you notice a lot of fixed costs? You should see a volatile net margin. So that's some of my argument. If a firm has a lot of fixed costs, their net margin will probably be more volatile than a firm that doesn't have fixed costs. So what does that mean for Costco? Costco has what kind of fixed costs? Must be pretty low, right? Because their margins are 3% or infinity. So it may not be that great of a theory, but Costco does have a lot of hourly workers. Is an hourly worker a variable cost? You know, does McDonald's say, hey, we got a lot of customers, so you can work for the next 37 minutes? Oh, but how many customers? We need to go home for 17 minutes. We won't pay, you know, you can't do that, right? So you have downtime, uptime. People are going to be working that whole time. So it's practically impossible. I do think McDonald's does have variable costs. When they sell a hamburger, there's bread, there's meat, there's lettuce. That's a fairly variable cost. So there is some there. So it's tough. So to me, it's more of a conceptual idea. But when it comes to revenue growth and earnings growth, so if revenue grows 5%, EBITDA should grow what? Greater than or less than 5%? What would be the normal situation? Your revenues grow 5%, what should earnings have done? You have a firm with a lot of fixed costs. Revenue grows 5%, earnings should have done what? A lot more than 5%, right? So that's the other thing you should notice. If a firm has fixed costs, their earnings should grow faster than their revenues. You're not going to find that with your companies because of what's going on right now in the economy. You're going to find a lot of firms, their revenues are growing faster than earnings. What does that mean? That's an interesting one, right? Revenues are growing 5%, and earnings are growing 3%. If revenues are growing 5% and earnings are growing 5%, that means 100% variable costs. What does it mean when revenues are growing faster than earnings? That's hard to figure out, right? That's a pretty tough equation. So that means they have shrinking margins. So there's probably something going on other than operating leverage. And it's probably competition, you know, those kind of things. They're not raising their prices as much as their costs because of the competition. So that's why you're getting some distortions here. So you can see what the accountants with ABC, they haven't saved the world because there's too many other things going on to make it really, really tough. All right. But you need to think through that, at least conceptually, try to think about your firm. This has become more important when we do paper 5 because you have to get a discount rate for your firm. And if your firm does have a lot of fixed costs, you're going to have a higher beta, so this can become important there. So how can you figure out the operating leverage? The way I do it is I look at the volatility of the gross margin and volatility of the net margin. To me, volatility of the gross margin is somewhat of an elasticity of demand. So if a firm is very price inelastic, then they should have a very, very stable gross margin. You know, they can raise their prices 5%, lower it, and doesn't really affect the volumes all that much. But if a firm has very elastic demand, they raise their prices 2%, their volumes fall 7%. You're going to really notice it in the volatility of the gross margin. And then the net margin to me is the volatility of the gross margin plus that operating leverage. So you're going to see that some of y'all seen that spreadsheet I create where we actually calculate standard deviations of gross and net margin. So you're going to have that. I've already done that work for you. So you'll see that versus the overall market. Now, I've had some students try this. You do a regression of your EBIT to revenues You can try that. I think you're gonna find there's so much noise that you're gonna have a little bit of a tough time. And part of your problem is gonna be you do the regression, you get a nice slope, and then what do? What does that slope mean? And to me, that slope, without comparing it to other firms, it really doesn't tell you much. Now, you could do that if you've got an industry that has 5 or 6 key competitors. You could actually take those 5 competitors and do a regression of their EBIT to the revenues and compare the slopes. And I would say the higher the slope or the lower the slope tells you the relative fixed cost of those companies. So you could do that. You got 50 competitors. You could probably set that up pretty quickly. You don't have to actually run the regression, right? You can just do the slope formula in Excel and look and see if there's differences if you wanted to try that. So it might be possible. The question is, do you bring in annual data or quarterly data? The advantage of quarterly data is you have more data points, but you also have a lot more seasonality and a lot more noise. You bring in annual data, you take out the seasonality, but you have 1/4 as many data points. So you might try it. I've had maybe 10% of students try that to see. I will tell you in the paper, if you try it and it fails, you can still put it in your paper and I'll give you credit for trying it. In real life, you wouldn't do that. But if you want to do it, say, hey, professor, I tried this and it showed me nothing, just to let you know, that's fine. You go ahead and try it. In real life, there's a lot of things I tried in my career that I spent, 2 weeks on, and then it's like, oh, that doesn't work. Then you have to explain to your boss, I discovered this didn't work. So, all right, so we're going to look at gross margin and net margin. That's very, very simple. You're just looking at it over time and versus peers. Very simple. Higher is better. Better than peers is better. Very easy stuff. This last one is not really telling you anything new from the net margin. It's just a picture. You're looking at revenue growth versus earnings growth. And you're just trying to see over time, how are those two things moving? And then is your revenue growth below your earnings growth, so you do have some evidence of fixed costs. All right, so those are the 3 things we're doing. So let's look at Walmart. So Walmart has maintained a very stable gross margin, which you expect from most firms. Most firms' gross margins are fairly stable. So if you have a firm whose gross margin is really volatile, that's a pretty unusual company. So you have to kind of stop and think about what does that mean. Sometimes with commodity-driven companies, it's possible, if you think about a Valero, their cost of goods sold is oil, and then they're selling gasoline, and those two can get off quite substantially because of just timing. Oil prices are pretty volatile. They may be getting oil today, and that's, whatever's going through their cost of goods sold, whether you're using LIFO or FIFO or whatever. So you can get some noise because of that can cause some volatility. But pretty stable margins. I mean, that you can just tell, very, very stable margin. Be careful on this chart. So if you got a chart more on the net margin, but you say stable, it just went from 12 to 10%, 12%. And students say, 10 to 12, that's not that big of a change. That's a huge change. What is that real change there? It's 20% change, right? It's not a 2% change, it's a 20% change. So on margins going from 10 to 12, going from 50 to 57, those are huge, huge changes, all right? So don't get deceived because, it's only 2%. It's a huge number, all right? So for a net margin to go from 10 to 12, from a gross margin to go from 50 to 54, or from 50 to 46, those are huge changes. And those may not show up in the graph because of the range here. Okay, so this was probably a fairly significant drop. It could be perfectly fine because they may be doing more groceries, and we know groceries have thinner margins, so maybe it's okay. But the other thing you'll notice here, I would guess Target would be up here, or Target would probably be close to the median. Costco would probably be down here. And that's somewhat you expect. That comes down to the business. Target can charge more to Walmart, probably for the exact same product. I don't know if you've ever gone to Target and Walmart at their exact same price. People still buy from Target. Why do they do that? It's a better environment or whatever, and it could be just location, right? The Target's 5 minutes closer. You're not going to go. I do know people that will drive 10 miles to save $1. Spend $1 on gasoline to save $1. and they put 0 on their time, that's possible. But why is that? Why do people spend more at Target for the exact same product? Now I understand the Costco, right? Because Costco, you have to have a membership and all that, but Target and Walmart, those are interchangeable. The switching cost is very low. All right, the net margin, again, you should say EBIT margin, stable and in line with the industry. So Walmart's below the industry on gross margin, but they're with the industry on net margin. Why? Because they don't have the marketing budgets or whatever, the other budgets, they don't pay their employees as much or whatever. They have other places where they're cheaper, and because of that, they can keep their margin in line with the industry, even though their gross margin is lower. It is a little more volatile, and it is definitely declining. You can see the effect of COVID. So your firms that have this COVID bump, when you get to your forecast, you got to kind of figure out how you're going to handle that COVID bump. All right, here's the strange one. So I think I'll tell you all this story before, but I'll tell you again. This was the big chart at USAA. We called it the alligator chart. And the reason we did is our revenues are growing like this, and we didn't do revenue earnings. We did revenues and expenses. Our revenues were growing like this, and our expenses were growing like that. Looked like an alligator's mouth. And our CEO put that chart up and go, what business can grow their revenues at 5% and their expenses at 10% and be in business 10 years later? And based on that one chart, he cut 25% of our workforce. And the amazing thing was, a year later, no one noticed. Those people are all gone, and everything was getting done. So he somehow cut in the right places. It was a huge cut. Most people are upset. There's one lady in the department next to mine. She came back and she was so happy. I said, why is she so happy? Where did she go? She went and she discovered she'd been let go. She was so happy because she was going to quit anyway, and now she's getting 1 year severance. And she was like, wow. We were assuming she went and they told her she wasn't going to lose her job, but she went, she was going to lose her job. And I'm sure she cried in the meeting like she was all upset, and then she skipped all the way back. I was kind of hoping, I knew I was retiring in 09. I was kind of hoping they would lay me off in 08 and give me 1 year severance. And it's like, okay, I'll take it. But anyway, so he cut 25% of the workforce. There was one lady I worked with. I really admire her. She did the analysis of her department, and she cut herself. She cut her own job out. And it was true. With her department, a good friend of mine worked there, and it's like, we don't have anything to do. I used to make fun of them because we had to do it in our weekly work report. We always had 20 things on our list, and they had like 2 things on theirs, and we're like, Ron, stop doing that. But they just didn't have enough to do. So that was pretty impressive. So this chart's not quite that. This isn't expenses. This is earnings. So you look at Walmart, their revenues are somewhat flat and kind of going up, but their earnings, and you can take COVID out. Does that mean Walmart has no fixed costs whatsoever? Obviously they do. Now I did EBITDA here, so I don't have depreciation in there, but depreciation is definitely a fixed cost. So that may be an advantage of using EBITDA here. And I'm actually not 100% sure I use EBITDA there. I have to go back and look. I got real sloppy on that part. And so how did I do this chart? I started with $1 and I grew that $1 by the growth rate in revenue, and I grew that $1 with growth rate in earnings. It's a really effective chart to do. You can show things. This is the one chart you're going to definitely need to change your y-axis to get it to look the way you want. Now, what do you do with fixed costs if revenues are falling? That's the tough one. Your revenues are falling 5%. If you have fixed costs, your earnings should fall more than 5%. So if you have negative revenue growth, you're going to have to definitely change the chart to go down, and it's going to be a little bit more difficult to talk about. So I don't see any evidence that they're spreading fixed costs over more revenues. What I see is evidence of an industry in really cutthroat competition. It's the Amazon or whatever effect that's going on here. So there's where I talk about the Amazon effect. So if you're doing NVIDIA, you might have to take that out of your paper. That's probably going to. That's EBITDA. Yeah, I don't know why I switched between the two. I should stick with just, and you also just stick with one. I mean, you can leave with what I have here, but yeah. Damodaran says we use EBITDA just because it sounds cooler. cooler word to say, but I'm not sure that's true. IBIT's not all that impressive, but you should pick the one that makes the most sense. I know in technology, EBITDA just dominates in technologies, but you know, it's fine. Depreciation is a somewhat random number. Then what you're going to do is you're going to summarize this. All right. So we did solvency and liquidity, and you summarize those, especially using credit ratings. Now you're going to take turnover and margin and summarize it. But here it's a piece of cake. Because all you got to do is multiply them by each other. All you got to do is take ATO times margin, and there you got it. So a lot of your firms are going to be really strong on turnover and weak on margin, or really weak on turnover and strong on margin. This is the great equalizer. You just multiply them together and see how it comes out. The other thing you've got to do on this chart is try to figure out why it has the shape it does. So we saw this bump up here this last year. You see it coming from margin. You don't see it as much there. You see it coming from margin. Do you see it coming from turnover? So you're trying to see, if you see a bump somewhere, where did that come from? Is it because turnover suddenly improved, or is it called margin suddenly improved? You'll probably be able to see that better in the Excel spreadsheet, though. So down here at the bottom of the Excel spreadsheet, you can see over time their turnover. I don't like growth rates of ratios. I have it here just because I'm just curious in the trend over time, but you know, growth rate and a ratio is kind of strange. But here we can see their turnover has declined slightly and their margins have improved slightly. But if you look this last year, what drove this last year? Margin improvement, right? So that's kind of interesting to me. Because I would have thought it'd been the exact opposite. All these people are rushing to Walmart to buy, you know, toilet paper or whatever. So I would have thought about that, but here you can see there's a big jump up in their margin. So you can use this part down here because the charts, because I have so many lines, it looks like a straight line, but you can see it really is not a straight line. That is a massive increase in net margin. That's not a 2% increase in net margin, is it? What is that increase in net margin? Almost 50%. That's a huge increase. Where is it versus their history? That's the best year they've ever had. But then you look at the chart and what do you see? Yeah, there's a little bit of a bump, but no, that's a massive, massive, massive change. All right, so go back. So here I can say it's mainly margins is the reason. Where are they? They're right in line with the industry, and they've consistently been in line with the industry. And then this last year, they bumped up above. So I'm probably going to assume they're not going to be able to maintain that. They're going to probably come back down. The COVID's a unique experience. All right. Questions up there. So let's talk about, we got 10 minutes. All right, so let me give you some examples. Why turnover and margin is so critical, why management spends 95% of their time talking about these things. So let me give you a few examples. Here's one from Tyson's. A new strategy, pretty important strategy. So just read these and ask, is the CEO worried about turnover or worried about margin or both? So everyone wanted to move away from improving commodity meats and toward creating value-added products. Does that sound like a turnover? So are they trying to say, you know, instead of just buying the meat, we're going to send you the meat, but we're going to put all the spices on it, or we're going to develop in some way. What is that going to do? They're always going to be able to charge more, but will they be able to sell more? Sell more will be turnover. Charge over more will also be turnover, probably more margin. Do you think they're more concerned with margin or turnover or both? It could be either one, right? Can't really tell. The common goal, in other words, was to enhance the meats, to cook them, slice them, then add sauces. Why? That's going to be a major source of growth. What does that sound like? Sounds more like turnover to me. When management talks about growth, they're mainly talking about revenue. They're not talking about growth in earnings. You can sell a pound of protein for $1 instead of 50 cents. You have added convenience. But what does he see at the very end? You get both top line and bottom line growth. What is he focused on both? Right? This is kind of the McDonald's thing. The margin on breakfast is bigger than the margin on lunch. And we're getting a lot more people buying our product because we now have, anybody ever bought a Big Mac at 8 a.m.? Isn't that grotesque? Even think about, I think buying one at noon is pretty grotesque, but do you actually do that? No, that doesn't make sense. Now they have a breakfast. There's another quote I could show you from GM. I don't have it here, but GM started cutting back where it sold cars, cutting back on Europe, cutting back on China. What's that going to do to turnover? It's going to crush it. If you stop selling stuff, it's going to crush it. So what must they've been focused on there? Margins. So they're finding the countries where their margins are so thin and so pathetic, and they're actually shutting. That's pretty material, right? A firm says, we're not going to sell there anymore. Think about Albertsons shutting down in San Antonio. That's a huge decision to make, that we can't do that anymore. Right? So think through that kind of what would you do if you're the CEO of your firm? Where would you focus and how would you do it? Finance, we're the, we come in like supermen, superwomen and say, you need to improve your turnover. It's like, oh, thank you, Harvard MBA. How are we going to do that? Well, sell more. Oh, wow, we didn't think about that. We thought maybe we sold less. Yeah. So don't think like a Harvard MBA, think like a CEO. How do you actually get more people to buy the product of your firm? What are they doing to do that? It's not easy. It is not, because everything you're doing, who else is also doing that? Every one of your competitors. You think Target's going, oh, Walmart's doing that thing. All our customers going to Walmart. Wow, that's kind of sad. Guess we'll shut down. No, they're like, no, we're going to kill them at their own game. So it's tough. So think like a business person. Don't think like an MBA. All right, I'm going to let you out a little bit early because I don't want to start this, but have